Hi, I'm Sarah Benwell, the Assistant Editor of Engaged Investor magazine. Mercer recently won the award for Best Fiduciary Management Provider at the Engaged Investor Trustee Awards 2015. I'm here with their Head of Fiduciary Management, Ben Gunnee, to discuss the issues facing trustees today and how fiduciary management can help solve them. Good morning, Ben.
Good morning.
So what are the key issues facing trustees at the moment?
So if we look at what trustees are facing from an investment standpoint, I think there's really three key issues. First of all, if we look historically over the last 18 months, 2 years, we've had a period of falling bond yields, and that's really hurt UK pension trustees and pension schemes. Liabilities have risen significantly as a result, widening the deficit, or put another way, that funding levels have decreased, and that's a real issue. Secondly, I think looking forward is there's general consensus that asset classes or traditional asset classes anyway, are reaching fair value or in some cases overvalued. So how are we going to generate return when we're in that sort of environment? And thirdly, there's the ongoing issue that trustees face around the governance of their pension scheme and also making sure that they implement things in a timely manner and in a cost-effective way.
Okay, and so you've talked about three key issues there. What exactly can fiduciary management do to help address these?
Yeah, so let's take each of those issues in turn. So first of all, think about the falling bond yields. Well, one way to limit some of that effect is to make sure that your assets and liabilities are matched as well as you can be. And one way to do that is to use techniques such as liability-driven investing, or LDI. Now, LDI is quite a complex investment area and can be quite expensive. So really, in Mercer's fiduciary solution, we use LDI in a very smart way that we can package it together for our clients so it's easy to access, and we also do that in a very cost-effective way using our buying power to reduce the overall cost to our clients. Secondly, thinking about the investment returns going forward, and the sort of fair value or overvalue of traditional asset classes. Well, one is thinking about those traditional asset classes. How can we be smarter about investing in them? So let's take equities, for example. Most people have a global equity portfolio. Well, when we design our equity portfolio, we look to incorporate niche strategies, more interesting equity type strategies that we can find to really boost returns for our clients away from the sort of standard way of investing. But we realise that introduces extra risk. So we dampen that risk by using low volatility equities. And overall, we can produce an equity portfolio with higher expected returns and lower risk, so a win-win situation for clients. But if those asset classes are looking towards fair value, then we have to be able to innovate and find new asset classes and new ways of investing for our clients. And it came as part of our award submission that Mercer like to innovate, and we like to introduce new things to our clients. Looking at a recent example that we've introduced into our clients' portfolios over the last 18 months or so is private debt. Now, private debt, we think, has very good potential for expected returns in the future, and its risk profile is also attractive. But it's very hard to access. It's very operationally complex to access and can be very expensive. So again, using Mercer's fiduciary solution, we're able to package that in a way to our clients that we can take all of that operational complexity away, and we can also deliver it in a cost-effective way using our buying power. And thirdly, looking at that governance structure and thinking overall, how do we implement things very quickly and cost-effectively? That's where fiduciary management really comes to the fore. We're looking at clients' funding levels on a daily basis, and where we see attractive to move away from risky assets and into matching assets, we can do that in a very timely manner. And finally, on that cost effective, I've talked about it before, but it's really about using our scale of having 130 billion of assets under management to really use that and leverage it for the benefit of our clients. So when we're going to investment managers, we're making sure we're getting the best rates, the best costs, and passing all of those cost savings on to our clients.
Recent research has suggested that only 5% of schemes are taking a fiduciary approach. Given all the benefits that you've just talked about, why do you think that number's not any higher?
Yeah, so I think you're right. It's around about 5%, but I expect that to grow quite rapidly over the next 3 to 5 years. And we've seen rapid growth from where it started. So why is it only still a small percentage? Well, one is it's a relatively new concept into the market. It's only been around really for the last 5 years. And so there's been a lot of time around educating trustees as to what the benefits of a fiduciary model were. And if we think about it, the UK trustee models existed for a long time. So when you introduce something that's completely different to the way of thinking before, it takes some time for people to get comfortable with that. They also need to see a track record. And now we're starting to see track records where fiduciary is really delivering results. And that's convincing clients that this is a very good approach, an approach that they may want to adopt. So that 5%, I think, over the next 3 to 5 years will more than double, probably treble, even potentially quadruple in terms of the size of the market.
Thank you very much, Ben.
Thank you.